What if I told you there's a single, powerful rule that underpins the price of pretty much everything in finance? Seriously, from interest rates and currencies all the way to the most complex derivatives, one core idea keeps the entire system in balance. And today, we're going to unlock that principle.
So here's our roadmap for today. We're going to start with the market's golden rule, and then we'll use it like a master key to unlock the logic behind future interest rates, foreign exchange rates, and even option prices.
All right, let's dive right into this foundational concept. It's a really simple but honestly profound idea that keeps the financial markets from just spinning into complete chaos. Well, the entire structure of modern finance is built on the assumption that the answer to this question is a firm, resounding no. And that simple answer leads us directly to our core principle.
This is it, the no arbitrage principle. You can think of it as the market's own internal police force. The rule is simple. If two different assets or strategies guarantee the exact same future payoff, they must have the exact same price today. I mean, if they didn't, it would create a risk-free profit opportunity, right? And traders would jump on that in a heartbeat until the prices were forced back into line. So, you might be wondering, how does the market actually enforce this no free lunch rule? Well, it's with this tool right here, cash flow additivity. This is basically the mathematical lens that lets us break down really complex investments into their simple, component cash flows, compare them, and prove whether two very different-looking paths are actually, from a financial standpoint, identical. Okay, let's see this in action. Here we have two strategies. Both require a £100 investment today, but notice the cash they pay back over the next 3 years is completely different. Just looking at it, which one seems better to you? To really compare them fairly, we have to deal with the time value of money. The idea that a pound today is worth more than a pound tomorrow. So we use a process called discounting, which brings all those future cash flows back to what they're worth in today's money. When we do that for strategy 1, let's say with a 10% interest rate, its net present value is £11.91. Now here's the really cool part. When we run the exact same calculation for strategy 2, even though it has a totally different cash flow pattern, we land on the exact same number, £11.91.
So what's the big takeaway here? Well, even though they look different on the surface, these two strategies are identical from a financial perspective. The no arbitrage principle dictates that you should be completely indifferent between them. There's just no free lunch to be had by picking one over the other. Okay, let's move on to our first real-world application and see how we can build on this. We're going to use this exact same logic to uncover the market's hidden expectations for where interest rates are actually heading.
Okay, imagine you want to invest for 2 years. You've got two basic choices. Path 1, lock in the known 2-year rate of 3.5%. Super simple. Path 2, invest for 1 year at the known 1-year rate of 2.5%, and then reinvest for that second year at whatever the 1-year rate will be 1 year from now. That second-year rate is our unknown variable.
So the no arbitrage rule demands that these two paths have to lead to the exact same amount of money at the end of 2 years. It's simple, right? If one path was predictably better, everyone would pile into it, and the prices would adjust until they were equal again. So we know they have to end in the same place. This formula really represents that core idea. Think of it like a balancing scale. On one side, you have the total return from that simple 2-year strategy. And on the other, you have the total return from the 1-year then reinvest strategy. For the scale to balance, for there to be no arbitrage, these two sides have to be mathematically equal. And this lets us solve for the one missing piece of the puzzle, that forward rate. And when we solve it, we get 4.51%. Now this isn't some psychic prediction from a crystal ball. This is the break-even reinvestment rate that's implied by today's prices. It's the one rate that guarantees there's no arbitrage opportunity between the two strategies. In a way, the market is literally telling us what the price of money is expected to be in 1 year's time.
Okay, so that was interest rates. Now let's apply the exact same logic to the massive world of foreign exchange.
So once again, we're going to compare two financially equivalent paths. Let's say you have $1,000 to invest for 6 months. The domestic path is easy. You just invest it at the US interest rate. But the foreign path has 3 steps. You convert your dollars to Japanese yen. You invest them at the Japanese interest rate, and, this part is absolutely key, you simultaneously lock in an exchange rate today to convert that yen back into dollars in 6 months' time. Okay, so the US path will give you $1,010.05 in 6 months.
The Japanese path is going to give you 134,433.6 yen. For there to be no arbitrage, that future pile of yen must convert back to the exact same $1,010.05. The only thing that makes this true is the forward exchange rate. And this shows us exactly how we find that forward rate. It's not a guess, it's not a prediction. It's the one unique exchange rate that makes the returns from both of those paths completely equal. Given the interest rates in both countries, the fair no arbitrage forward rate has to be 133.096 yen to the dollar. All right, for our final application, we're going to use this same simple principle to tackle something that seems a lot more complicated: pricing an option. You know, a contract whose value depends on the uncertain future price of an asset.
So let's just simplify the world for a moment. Imagine an asset is trading at 40 yuan today, and in the next period, its price can only go to one of two places. It can go up to 56, or it can go down to 32. And we want to figure out the price of a call option that lets you buy this asset for 50 yuan.
Now here is the genius move. We don't actually need to predict which way the price will go. Instead, we can use the underlying asset itself to perfectly hedge the risk of the option. By combining the two in a very specific ratio, we can build a portfolio whose future value is known today with 100% certainty. The math gives us a precise recipe for this. We need to find a ratio where the gain on the asset, if the price goes up, is perfectly canceled out by the loss on the option we sold. And, in the down scenario, the loss on the asset is canceled out by the gain on the option. In this particular case, that magic ratio is buying 1/4 of a unit of the asset for every one call option we sell.
Now get this, if the asset price goes up to 56, our stock position makes money, but we lose money on the option we sold. What's the net result? Our portfolio is worth 8 yuan. Okay, what if the price goes down to 32? Well, our stock position loses value, but the option we sold expires worthless, which is a gain for us. The net result? Again, our portfolio is worth exactly 8 yuan. We've created a totally risk-free asset.
And because we now know with absolute certainty that our portfolio will be worth 8 yuan in the future, pricing it today is easy. We just discount that risk-free payoff back to today's money. And since the only unknown in our initial portfolio value was the options price, we can now solve for it. The fair, no arbitrage price for that option absolutely must be 2.38 yuan.
Okay, so let's zoom out for a second and just appreciate the incredibly powerful, unifying idea we've just explored across 3 completely different corners of the financial world.
Just think about what we just did. We've unlocked 3 very different financial doors: interest rates, currencies, and options. But we use the exact same master key for every single one: the principle of no arbitrage. At the end of the day, this principle is what makes sure that all these seemingly separate markets are logically and mathematically intertwined. It's like the invisible grammar that makes sure the language of finance is consistent and fair for everyone.
And this leaves us with a final thought to chew on. We've spent this entire time using a principle that's designed to find fair value by completely eliminating risk. So it really begs the question, if that's how fair prices are set, where do actual investment returns come from? Maybe understanding the price of no risk is the first crucial step toward understanding the true value of taking it.